All right, welcome back to another episode of Just Figuring It Out. I've got the crew here. We've got Ian and Alex. We've got a really, I don't know, something that's been coming up over and over again. First off, Alex, Ian, how are you guys doing? It is August 21st. We're almost at the end of August. How are you guys doing?
I am fantastic personally and excited to be here. And I have strong, angry opinions about this topic. So I'm excited to dive in.
Woof. I concur.
Let's get into it. We're trying to look at things of what's been coming up recently in the business and just what we're seeing on a weekly basis. And I've just been seeing this come up a lot, which is, hey, should I be comparing my business to industry benchmarks? Or how do I even know what my industry benchmarks are? And before we get into this, I did just a little bit of research, I think, to set the table here of like a couple things here that I think are important. One is, I think one of the things that we've always hear is, and this is where I think benchmarking is really interesting. I had to ask Claude this. I wasn't really sure. So I was asking AI, do benchmarks consider all businesses, or is it a specific certain sample of businesses when they're getting their information? So the reason this is so important to me and why I was like, well, how do we even know where this is coming from, right? Just like we talk with our clients, data in, data out. But well, how do we even know where the data is coming in from? And so a couple of things. First off, I just want to break some stuff down for you guys. Things that we've heard over time. I just want to kind of review this here because on my mind, I was thinking, well, do they take into account all businesses? And we always hear the phrases, well, X% of businesses close in the first couple of years, 5 years, the success rate. And so then it's like, are we taking a full sample of all of these businesses? I think this is really important because if we don't really know where the data is coming in from, how we're selecting it, how do we even know how valid it is? So a couple of things that I think are interesting. This is from Claude that's pulling from resources. So full transparency, if you use a different AI tool, you might get a little different answer, but this is what it's saying about businesses that fail. So about 20% of businesses fail within their first year. This is coming from the Commercial Institute and Clarify Capital as their sources. So take that for what it's worth. About half of businesses fail within 5 years and 65% fail within 10 years. And what's really interesting, this gets more specific by industry. So construction is one of the most failure prone sectors according to Revenue Memo, with only 30 to 40% still operating after the 5-year mark. So 60 to 70% going out of business. Healthcare shows the highest small business success rate with 60% surviving beyond year one. I think it's really interesting from what we've seen of what success means of still surviving and being around. Might be a little bit interesting there. And then agriculture, this is interesting, has the best long-term survival at 50%, still operating after 10 years. It's according to SCORE. So top reasons businesses fail, no surprise here. The 4 out of 10 businesses close because they simply run out of cash. This is according to SCORE and Clarify Capital. I've even seen it up to, there's a Chamber of Commerce study they did that 82% of businesses, the reasons they have to close is because of cash flow issues, running out of cash. We see it all the time. Got to go take out MCA loans, go take out merchant cash advance loans, getting all this kind of stuff and put yourself in a bad spot. So this is really interesting. I asked, hey, do you know if industry benchmarks are usually set by only successful businesses, or how do they take into account, or do they take into account all businesses in any industry? Do you guys have an idea? I'm curious what you guys.
I just have such strong negative opinions around this and some level of like skepticism around all the data because I'm sitting in all these other businesses and I'm like, how can you possibly say that any of this data is actually accurate? Sorry, not that I have any.
No, it's a good point. We're gonna get into that. It's a good point that you raised. We're gonna get into that. Ian, any initial thoughts on this?
Yep, sure do. So the initial thoughts are similar to the route you're going, Will, where it's like, hey, what are we even considering success? Because I think that's really important where they say, this business still exists. Great. Did they take on another $250,000 in debt to keep existing and they're not paying themselves anything or not profitable for 10 years? So it's like, and I think of this too, when you said agriculture, I'm like, well, are we including subsidies? Are we including is this a small farmer that like owns the land and isn't going to be like, yeah, I'm just going to give up all my stuff. So I'm going to work differently at survival versus somebody who's like, I'm going to give it a shot. So there's all these other factors. I think I just tend to consider the human so much and the variable factors versus, hey, X sector. I just tend to look at it like there is so much variability within all these sectors, and sizes of businesses are such a huge thing too. What the owner wants is such a huge thing that I think is never considered in these surveys. And that's, if I go to the crux of my biggest with it, is it's rarely ever serving did we start with what the owner wanted to do with this business? And I would love to see a data survey on success based on those things.
Yeah. I guess I just put this out to you guys. Do you guys have I love just a sense of what do you think comprises of benchmarks? Do you think I'm just curious, if we put our heads together, how would we go about sampling this this is really interesting of people are basing major decisions off of going off of this, right? And so my thought was you have to have a full sample size of all businesses, right? You got to have a full, that's my initial, I don't know about you guys. Where do you think
Yeah.
that, yeah, just
So
curious.
so just because every business model is so different, to have any benchmarks that actually matter, you have to segment down to like, now we are talking about brick and mortar healthcare businesses. Now we are talking about brick and mortar retail businesses. Now we are talking about brick and mortar auto repair businesses. Now we're talking about brick and mortar auto sales businesses. Just because all the labor, materials, COGS, debt percentages, all those things are going to look drastically different because of how all of those operate. So you can't, to your point, Will, like you would want a broad sample size, but of a specific kind of business. But then the problem becomes, well, is this geographically pointed or not? Because a business in, I don't know, Iowa is going to look very different than a business in California, even if they have the exact same business model, because their cost of living is different. Their labor is going to be drastically different. Their taxes are going to be drastically different. So you start saying, like, well, how useful are benchmarks if, like, are they specific to my industry? Are they specific to how I run my business? Are they specific to my location? And then, like, well, is anyone in my area actually charging right and making it? Anyway,
Yeah.
this is,
Well, which gets to, no, it gets to where what I guess I'm not asking correctly to you guys is if you guys had to go out
yeah,
and create this,
yeah.
how would you sample data to feel like you're getting an accurate reading? And how would you get that from business owners? Because it's really
First, I would
important.
ask myself, why am I doing this? And is this actually a good idea or not? After falsely deciding that I should do this and that it is a good idea, then I would go sit down with business owners and I would, like, honestly, you would have to look at their actual books, because just asking the business owner, as we know, the business owner isn't going to actually know the true real answers in most cases. No slight to business owners. We've been there too. Like, you just don't, you think you might know those things off the top of your head. So pulling the individual owners is not the answer. Two, if I were to actually look at their books, which, like, how many businesses are going to be like, here, let me just give you my books so that you can do things? One, like, that's probably not going to happen. But two, like 90% of the businesses that we talk with, and granted, we have a slanted sample size because of what we do, or sample type, they don't have accurate books to begin with. And so the idea that you're going to say, hey, now I'm going to use your primary data, your books, to do this is also like, well, have you validated that that data is actually accurate? That's a massive lift. Ask me how I know. And so I don't see any realistic way other than self-reporting or actually looking at the data source, and the data source is often wrong anyway, to get these answers. And what they're ultimately probably doing is aggregating a whole bunch of answers together and getting averages, right? Like statistics. And so with both of those things, self-reporting probably being fairly inaccurate, and or their actual books probably being fairly inaccurate, at the core source, I don't see how there's a realistic way to say, yes, this is accurate benchmarks. And even more important, is this a profitable business that I actually want to benchmark off of? Or am I benchmarking off of people who are losing money hand over foot?
Yeah. We're getting into, let's say getting into should people do it or not. I really want to get into like just the kind of our internal, how we would do methodology if we had to do it, because I think it's really interesting what they actually do and how we get here. And so for me, it's like to hear that you bring up some great points, which I think are so true, which is, hey, how do we even get people to give us their information? Right. And we're going to dive into like how they actually collect this data, right? Because that's something that's really important. It's not like we run a small business. I don't get an email from I've never got an email from someone, hey, do you want to voluntarily submit your books to us to be a part of a benchmark study? That's never
Which,
happened.
which if they did that, would now skew your sample, right? Because you're only talking to people who are like, yeah, I want to share my stuff. My numbers feel great, right?
Yeah. Which is why I want to do this exercise. Like, how would we, three smart people put together to actually, how would we go about potentially getting some kind of accurate sample of this? And I think, Alex, you bring up like great points, which is like, there's going to be a lot of challenges to this, a lot of hurdles to actually get accurate stuff. Ian, I'm going to toss you because I know you've been sitting there and thinking too. We'll get into like, obviously, making our conclusion of should we do this, should we not base anything up benchmarks, but just sort of thinking through the framework here, because again, there's so many companies and business owners who are saying, I've got to hit, certain benchmarks. I was on sales calls this last week of like, well, I know my industry benchmark is supposed to be this, industry standard is supposed to be this. And, it's been hitting me of like, okay, we need to do a deep dive into this of like, why this happened. So Ian, just curious, you're thinking through this, any ideas of sort of like how we would actually go about creating good methodology to get clear benchmarks if we were going to do this?
Man, it's probably not a great answer for people that want quick and data driven. It's going to have a lot of conversations, because I think the piece that's missing from all this is the story. And I think that's the thing that's very challenging to get unless you have multiple conversations and you have other people checking on and verifying those things. So I think of it like this, it'd be like doing true due diligence in a business. If you were to invest or partner with that business, even those people who do that for a living miss stuff. And you go back and say that's inaccurate. So trusting someone to self-report, or even if you think of like these large public companies who have to put numbers, what level of detail is happening, who's checked, like they have to do these things because of compliance. And I'm sure there's still errors all the time. So it's thinking about that versus, all right, if I were to go say figure out what I have an HVAC company and I'm doing 2 million a year, like now how would I go figure out how I was doing compared to all of the HVAC companies that are doing 2 million a year? And I would say, wait, am I a single owner or do I have a partner? That's going to change a lot of the metrics of the business. And then I might ask myself, wait, how are these other businesses funded? That's going to change the metrics of the business very, very, very much and what I have to do. And you guys know me. So the other thing I'm going to ask is like, what's the reason this business exists for me? Or what is my intention in the long term? Is it to grow to a sale or do whatever else? And I think when people get stuck in industry standards, what I've noticed is it's one of a couple things. One is going to be, I feel like it needs some sort of measuring stick to be like good, bad, right, wrong. Am I on track? Am I off track? Which I totally understand. Makes sense. Two, they went to some mastermind course or something that said you have to hit these standards and then you'll sell at this multiple and then you do this and you'll make your 10, whatever it is, right? Hit 10 million revenue at blah, blah, blah percentage margins and then someone will buy you for X. Same thing, like this good, this bad. And my response to that is always, well, it depends. Like, what's the money for? Or what's the thing for? Or what's the purpose of the business? I think what's so hard is that's just never in the ones that I see. It's never in there because it'd be so much flipping effort to go get this information because you'd have to interview a lot of people and then follow up on like, is it true? So for me, it'd be a smaller size. I'd pick a geography. I'd really try to tie it down to the variables of what I'm doing to say, can I actually mirror that and find that in another business? And the other thing I'd say to this, Will, and it's a good point, is when I think this is helpful looking outside of business, it's less of comparison and more looking to innovate or be like, hey, is there something out there that is like useful that I'm not seeing because I'm in my bubble, without being like, I have to do that thing. Because I might go find, wow, I'm actually doing better than a lot of like these other people that are trying to hit these standards because they're so focused on these standards that they're kind of missing the other parts of the business that are important. So anywho, long-winded way of saying, if I were to do it, I'd try to really tie it into just, am I mirroring something that I currently am fully to compare? And is it apples to apples? And that's very hard to find.
I will say to that point, there are a couple of benchmarks that I have internally created over time because I have worked with the same kind of business over and over and have had deep conversations and have seen over time that scenario play out. And so I think the very best quote unquote benchmarks are likely to come, and if I were to do this myself, would come from niche specialty experts that are working with those businesses day in and day out and can understand like, oh, broadly, I've seen this happen for these 100 businesses over and over and over and over. And therefore, I know that this is the range where things start to make sense for this specific kind of business. Like early on, we worked with a ton of cash pay physical therapy practices because of our physical therapy background. So I know the benchmarks internally that I hold around how much they can pay to hire someone and at what hourly billing rate it starts to make sense and they can hit six-figure salaries for their PTs, right? But that's not like I didn't go ask a bunch of owners these things. I sat in a seat for years with them and started noticing patterns because I was just spending so much time with them and saw over time how things worked. And so I think that's probably the most reliable way to do that. But again, that requires lots of hours sitting in a very specific seat. And those don't apply outside of cash-based PT well. Like it doesn't even translate over to OTs well because of how their billing and stuff work, So it's like not broadly useful and applicable.
Yeah. No, I think you make some great points, and even then would be biased, right? Of it's from what you've seen, right, and kind of what you feel is sort of
which is correct, of course.
Well, of course,
clearly.
Yes, of course, which we're getting into. What is correct, of course, which is why I think is really interesting. So I started asking, and I was really curious to go down this. I was like, I hope you guys find this interesting because
I do, because I don't actually know
love it.
how they do this.
I
I
love
don't
it.
know
yeah,
the
it
clue.
was something where I'm like, oh yeah, benchmarks. We've had CFOs who've worked with us come in and go, hey guys, can we get a tool for industry benchmarks?
Can I say one more thing before it's said out loud? The one place I've seen lots of benchmarks come from is from reported sales of businesses. So like business brokers will have a lot of this where they're like, "Hey, here was this business and we did our due diligence and this is what we saw." But again, that's a skewed sample size because those are businesses that in either case are either like failing so bad that they need to sell. The owner wants out, or they have prepared their financials over years to get high multiples and have been organized, or are like, let's be honest, there's still a lot of times when people who sell businesses are fudging the numbers. And so I still don't think that's an accurate representation, but I've seen a lot of benchmarks pulled out of that kind of aggregate data after someone sells.
Same with software companies. I've seen a lot of them posting, here's of our X amount of people that we serve because I remember back in the day, you guys remember MindBody? Did you ever use that?
Oh yeah,
So
yeah, yeah.
I
The
remember because
scheduler did a lot of scheduling, like CRM kind of stuff for health clinics.
and because it was skewed towards health and wellness, it was like yoga businesses or a clinic or this. So it had, hey, we know your business type, we know it's of this size, we know these things. But then I laugh and think like, I know how I use software and I know how teams use software. How accurate is the information they're putting into their software consistently? And if those are, because they're of course sanitizing it, they're not like they're out of our 8,000 yoga businesses. Here's some averages, which once again could be helpful to an extent and motivational to some people. But I just love it personally for innovation and saying like, hey, is there something outside of my domain that I might not be seeing that could be really cool to like try? Or hey, if I never owned a business, it's that kind of thing of, can I start with a perceived template? I totally get that urge to do that and look. You have to, right? You have to start and look and say, this person seems successful. Like, let me see how they're running their business. This is how things are taught. So I think that's extremely useful, and I think it's great to look at it too. I wonder, yeah, software ones. I'm actually curious if you guys have probably got the consensus stuff, right? Where you'll just get a card that's like, this is going to take you whatever time and fill it out for the government to tell us how your
Over
business.
like the normal census of like humaning. Yeah.
So I don't know how detailed a lot of these things are. So from what I've seen from most of these studies, they're just using either general financials, really like generalized, or submit your data, or we're going to come in and look. But I'm curious. I could be wrong. There could be some that are like super integrated with these businesses, which would be fun. Yeah.
Yeah, you guys ready to dig into it? I got some
Please tell me things. I love
some
this.
stuff here.
Now that we
Again,
have hedged fully.
yeah, this is. I wanted to bring it up, right? Because I've been in these, I've been in this seat this last couple of weeks, having these conversations with folks who are like, I just want to be able to see my industry average, and I've always had a belief of what I thought benchmarks were and why they're not important and all this kind of stuff. But then I was like, I don't really have anything to back that up with, and I don't think I was curious if you guys. That's why I wanted to ask of like, do you guys know where this comes from? Because I didn't know where benchmarks come from. Why did they become important? And we see people who, like I said, are making decisions based off, well, I see in my industry it should be 40% gross margins, and it's like, okay, let's dive into that. Is that real? Is that not real? So it's really interesting. There's a gold standard of benchmarking. I'm using AI. I'm using Claude. So I think we're being open and transparent about that. If you want to go and do your own research, you might find something different, but this is what I'm going off of. So there's a group called Risk Management Association, formerly known as Robert Morris Associates. I feel like we've probably heard of Robert Morris in some way. Never really knew what they did, but some big group. They're a respected trade group of lending and credit risk professionals. I think that's important. It's people who are coming up with this are a trade group that does lending and credit risk assessment for professionals. They now operate under ProSite Financial Association. So if someone can't find them, just so you know, it's commonly referred to as an RMA benchmark. So that's kind of what it comes from. So what is RMA? I think this is interesting. A massive annual compilation of financial data organized by industry. Common size financial statements and 16 clearly defined ratios are presented for more than 640 specific industries, organized by something called NAICS codes and sorted by both sales and process. So this is really interesting, right? So this is just a setup of like, who's determining this? You're going to look at this information. It's always nice to know what's kind of their incentive to all this. Yeah, Alex, go ahead.
First yellow flag, NAICS codes change around so much. It could be so different for anyone who's ever filed taxes and their guy's like, what NAICS code do you file under? I don't know. There's like 5 that I could do. Anyway, sorry.
Yeah.
Keep going.
No, it's true, right?
fascinating.
Yeah, it's I think that's true. It's like, you're filling something out. It's like, how would you define yourself by one of these 5 categories? And like, well, multiple apply, but you have to choose one. And yeah, you get kind of the skewed data there. So I thought it was really interesting. Hey, before we get into this, does this group RMA, do they sell anything? Like what's their incentive for this? What do they do? I just think it's really great to know that in the back end. So yes, they absolutely sell things. It's a membership association, but they also sell data products. And here are the things that they do. So for banks and member institutions, members who participate get a complimentary copy of the annual statement studies. So they're selling that. For non-bank professionals, they sell access through a few channels. They offer annual online subscriptions. Think for a lot of, for people who do valuations are buying into this reports and getting these reports. So there's absolutely an incentive here to do this and to keep people curious about benchmarks, because that's how they keep selling their data and their products and services. So I think that's really interesting there. Just to get the background, we'll get into this. So where does the data come from? How do they pull these? I thought this was super interesting. So, and I may have to pause here for you guys to help give some more clarity on this as the more financially astute folks as we get into this. But the RMA, quote unquote, the gold standard that most bankers and valuation pros use. All the study data is voluntarily shared with RMA members by the members, specifically US-based financial institutions. The data comes from the member banks spreading software into an RMA submission utility. Jumbled words. From May through August each year, they gather more than 180,000 financial statements. Claude goes on to say, here's what's actually happening. The financial statements are contributed from member institutions that get their data directly from loan customers. They request anonymized financial statements, including all companies in all industries in commercial, mid-market, and business banking, balance sheet, and income statement. They accept CPA repair, blah, blah, blah. RMA itself says, here we go. The only source of actual company data that hasn't been subjected to algorithms, modeling, forecasting, or backcasting to create the data set. RMA is the only source that doesn't do that. So here's some things. Sorry, I know that was a lot of words. I asked.
So wait, Will, can I just repeat back so I understand it?
We feel validated.
So basically they're saying, hey, we're a big group of people. We sell reports to banks and we get our data from those banks from their loan documentation. When they make a loan, it gets anonymized and sent to us based on any ICS codes. And then we say, cool, this must be what all businesses do based on loan applications.
Nailed it. Yep.
Pros and cons.
Yeah,
I like
pros and cons.
Actually, that I wasn't thinking about. I like it from a risk management standpoint.
Yeah. Okay, sorry, keep going.
No, so it's interesting, right? Like, how did this come about? And it's really interesting now to think about, like, Alex, to your point, who was even invested in this in the first place? Who had something to gain from this, right? Which is these loan officers, banks who are lending out money does this make sense? Is this a good business to loan money to invest
Do
in?
I think this business will exist in X amount of years?
Yeah. So
will they pay me back?
Yeah, exactly. Will they pay me back? So it's really interesting. It's really interesting stat here that, from Value Source, over 3/4 of valuation experts say they use this RMA for financial benchmarking data as well, determining selling a business. So it is somewhat important in some degrees if you're working with a broker who is looking at, hey, I'm potentially considering your valuation based off of some of these benchmarks. So I do think that's important that we take that into account, that if you're going through a broker, that seems to be something that does matter for something like that. So I want to go in, and this is really interesting. I asked, okay, so what are some of the pros and cons here? I guess I'll toss to you guys, pros and cons of that method. You guys are inside these businesses all the time. I'm going to go through, obviously, surprise, there's more cons than pros, but curious for you guys, what kind of comes to mind as you're thinking through that? So Alex, you did a great job. Could you repeat that of kind of where the sources come from?
Yeah. So big old company that sells data to banks so that they can lower their risk when they're deciding if they're going to give someone a loan. That's where this is coming from. So then all the actual data we're saying is coming from loan applications. So when people are like, I want debt, they submit all their financials to the bank. And then the bank says, sweet, we're going to put that together and send it over to this company, which I'm assuming, like, there's a couple things still that are unclear for me, and I can go look it up, but I'm stupid. So I'll just say it. It talked about, I wasn't clear if it was like, hey, this is coming from bank records themselves, like bank statements. Yeah. Which, if that's the case, then less useful. And what I think I understood, though, is like, hey, they're submitting other reports. They're submitting cash flow statements. They're submitting profit and loss, right? They're submitting stuff you would give to a loan officer when you're requesting a loan, which is actually a ton of data, like ton of data, and mostly like PDFs.
My guess would be like 3 years of minimum of financials in the business.
Yeah, tax returns and all that. So on the one hand, like, if I were to go say, what is the most institutionally thorough way to go in mass collect that data? That's probably it. Like, kudos for that. But then the other piece of this is a couple things. One is bias. We are biasing towards people who are getting debt. So that to me is an interesting, gigantic slant that like not every business so we are basing benchmarks off of businesses who say, I don't have enough cash and I need more cash, literally.
We're
That
going
to
to
me
get this. Yeah.
is a huge bias that like, oh, I'm going to base my business off of all the other businesses that are going to get debt so they don't go out of business. Now I get it. There's other reasons for debt. There's growth. Yay, we can go buy buildings. Yay, we can do all those things. But fundamentally, and I don't know what percentage of loans go towards like acquisition of assets at a bank versus like bail me out because I need a line of credit. And just from our perspective, like I wouldn't want to be basing off of that crowd as the core, like, this is how I'm building my business off of these businesses that need debt. So that's just an interesting, like deeply flawed thing that I've never heard before. That's fascinating. The
Yeah.
other thing is businesses who tend to need debt tend to have, like on the larger scale, tend to have some level of, let's call it disorganization in their business. And we've gotten debt before as well. Like I'm not casting judgment on anyone here, just saying that like
That's
when you're in a
helped us
position
tremendously at
that
times.
you need debt,
Yeah.
it's often because either there's growth and yay, cool, that's one camp. But the other camp that I would say is more likely is this camp of like business is struggling. And when business is struggling, like I have seen, and I'm working with clients right now where like we're going to get debt. And again, the books are so messy. The numbers are so messy. And so there's still not any checkbox of like, these are actually correct numbers. And someone's saying like, well, Alex, they're going to get loans and this is what the bank is accepting. Yeah, I know. I've been on the other side of this. And if you go talk with the loan officers, they'll say that too. Like, yeah, we're just trying to squeeze this through underwriting so that we can get at least some semblance of, we don't think that you're going to go out of business in a year. And so again, that doesn't solve the like flawed data, flawed numbers piece. And then things like how much of your money is going to direct labor, which that's what these benchmarks are for. It's like, hey, how much of my money should go to this thing? And those financial documents, very rarely, even if they're being submitted to a loan officer, are going to have an accurate breakdown of that based on how someone has structured their profit and loss statement, what their bookkeeper's doing. Very rarely. And so now we're saying, hey, these are biased reports coming from people who need debt. And like there's messiness anyway in those books still. And they're still probably not accurate from a breakdown standpoint, period. It's like, well, great. Why would we say that this is now gold standard for how I should operate my business? Because what a banker is looking at is such a different thing. And what the IRS is looking at is such a different thing than what a business owner is looking at. And I'll stop there. I have many more thoughts, but yeah.
No, you're good. Yeah, and just to answer a couple of things before, Ian, I want to get your takes here that I think just to clarify a few things. So I was asking, what do you have to submit to this RMA that is the gold standard, this Robert Morris Associates group, right? And so it's really interesting. They really just rely on two core financial statements, the balance sheet and income statement or P&L, right? So those are the two things. Really interesting. It said what's most notably absent is a cash flow statement. It's not collected, not taken into account in terms of these benchmarks.
Can we say why that's important?
Please.
So a profit and loss statement is not going to show you, here's how much of your money goes to debt every month. So it's going to show you all the like, here's my income, here's all this stuff, but it misses a big picture. And this is what the income statement is important for. It's like, well, how much are the owners actually getting paid? How much of this is going to pay back debt principal on things, which gets hinted at in the balance sheet, but not explicitly said like, here's how much of this they're paying. So it's missing a giant picture. There's a couple different things that the balance sheet and profit and loss statement don't clearly show. And it's like missing a whole picture of the cash flow situation of the business at the end of the day.
Yeah, I've got sort of a wrap up after this, but Ian, I want to of sort of, some of the other things that it doesn't capture or encapsulate that we can take into account. Ian, just kind of curious on your side going through this, I guess if you, as you're thinking about this, someone's coming to you and they're saying, hey, I just feel like everyone in my industry is at 40% gross margins on the benchmark. What are you thinking? Like, now kind of knowing a little bit more about, I'm going to go into some of the, there's a couple more really interesting things that I think are fascinating about how they do this, but I want to get your take real quick on like, just kind of where you're at after kind of knowing what you know now.
I would say watch this 10-part docuseries on just figuring it out about how the agencies that set the gold standard. I feel like we're uncovering things, and I feel like Alex needs
You feel like I need a what?
a red background because you're getting all fired up, and I love it. I love it.
I do. Sorry.
So for me, it's this. I think standards, if they're not set in ranges, that's already an interesting red flag. I also think that if the owner was saying to me like, they're at 40% and da 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 da, I mean, the first thing I'd be like, hey, show me what you're looking at, or talk to me about what you're, and I would ask the obvious question of like, what part of that matters to you most? And they might just go, I just feel like I'm behind, or I feel like they're better than me, or I feel like that's what I got to do in order to be successful. And then I'll look. And sometimes what's really fun is when you go look at that business owner's financials and you're like, yeah, you're extremely healthy, paying yourself more than what you thought you would. You're enjoying your business and your life and everything
And that
else. And I'm
key
like,
piece is going to come into play here in just a minute. So, yeah,
are you teeing me up here?
you teed me up. You teed me up. Okay.
So then I'm going to go, do me a favor, go interview a couple of those business owners that have the industry standards and see how their life is going. That's what I might say. Probably sarcastically. Say more.
100%
I
sarcastic.
am very excited right now. Go.
Yeah. Have you guys liked this style? I was thinking more of like kind of some things I've been listening to. Have you guys ever heard a podcast, The Rest is History?
No.
So good if you haven't heard. It's these two British guys. They do an amazing storytelling version of these huge historical events, and they just do phenomenal research. And I was like, rather than just how do we feel about it, I was like, I want to do some digging. So I hope it's been, if you're listening to this, I hope it's been helpful. Also, if you're listening and you are a benchmark expert and you feel like, hey, Claude is an idiot. You guys don't know what you're talking about. We'd love to have you on. We'd love to get a different perspective on this. But I want to go through just a couple things here and then we'll get to kind of last because I think some of these things are just really interesting. If we had more time to sit with it, you guys probably would have been like, oh yeah, duh, obviously that makes sense. But for someone like me who doesn't come from technical financials, I just think it's really interesting to see some of the stuff. So Alex, you brought up a really good point. Ian, I think you touched on this as well. One of the things to consider is that RMA, again, this group, gold standard of benchmark that creates the benchmark stuff, only captures businesses with active bank lending relationships. So you're seeing companies that were creditworthy enough to get a loan and they're still operating, right? Which we know a good chunk of businesses are going under every single year, right? So it makes a good point that is really important, Alex, to your point. $1 million a year contractor who's just running off cash flow and a credit card, something like our business running off cash flow and a credit card, no chance of being involved in a data set like this, right? We're not even getting reached out to. There's, as far as I know, zero chance we could be a part of it. We skew their data if they're like, hey guys, let us in. We want to send you our info. That would skew the data, right? To go through that. And this is another thing. None of these are capturing owner compensation accurately. So a contractor doing $2 million a year who pays himself $60K on W-2 and takes $200K in distribution looks like he's got a much higher profit margin than someone who runs on $150K in salary. That's it through payroll. And so the benchmark doesn't normalize for that. So if you're comparing apples to oranges on the single most important line item for an owner in the business, there could be a huge gap of what's going on there. So then I said, okay, what else are the other blind spots in this? I brought up survivorship bias. So the data set only includes businesses that are currently operating and have an active bank lending relationship. Alex, you hit the nail on the head on that one of like, you got to be in a certain level of position to even be going to a bank to get lending. Selection bias and who's even in the sample. So this RMA, they even acknowledge themselves that the data may not be fully representative of any given industry because the statements aren't selected randomly or statistically reliable. And member banks voluntarily submit whatever raw data they have available. Meaning, and this is where I'd be curious to talk to someone at one of these banks, like, can they just pick and choose what they're sending? Does it have to be all of it in a random, a certain amount in order for it to be randomized? That doesn't seem to be clear. I'm sure this is through, again, take that one with a grain of salt. It's from Amazon NOS, which might be Amazon News, but Amazon NOS only captures business with bank financing. Owner compensation is a mess. Alex, you hit on this earlier. I think Ian, you might have hit on this too. Geographic blindness within categories. So a plumber in Salt Lake City is going to have, even though he's going to have the same NICS code as someone in Minneapolis, their cost structures are going to be different in terms of material costs, labor costs, insurance. They don't take into account regional breakdowns of things like that in terms of those numbers. And then the last thing is no operational context. So the data tells you what margins and ratios look like, but nothing about how those numbers were achieved, what it took to get there, the team in line. So wanted to break that all down for you guys. I have a sense of what we would say in terms of your kind of final conclusions on whether or not these are important, but I want to at least get a sort of a final take on this from each of you. So, Ian, I'll start with you. I heard from you. Kind of knowing what you know now, going through this, does it validate what you already felt? Is there any sort of change of how you might push back on someone who's like, man, we really got to aim for these 40%? Because I do think, or 40% margins, because there is one thing to me that could weigh on someone, which is, well, if I'm going to go to a business broker and I want to sell this one day, and they do take into account these benchmarks, should I pay attention to that? Right. And like that I could see where that's one thing someone might cling on to. So I'm curious for you, you got someone looking at all this stuff. What are you thinking? How are you going to talk them either into this or off the ledge?
Yeah. First thing is I feel seen and heard. Thank you for all of that information. curious what I was going to say, honestly, because I was more curious, are there things I'm missing around? Maybe they've got some access to something that I don't know about. I still am going to be very similar. It's just the way I operate as a human. I'm just genuinely interested in what the person across from me is seeking and why they want it or why they're seeking out certain information. I can't help it. I'm like, I need to know. So I think for me, once again, if it's something if in doing that, it's going to get you closer to what you want in life or in your business, and that's the best route, then sure, have at it, go nuts, learn industry standards, do that stuff. I think for me, it just becomes, do you know how to set your own benchmarks? And can you set the standard? And I think that's the key there. And if you're looking outside of yourself to do that, it's okay if you're like, I don't have any ideas and don't know where to start. I totally understand that. But if you've been running a business for 3, 5, 10 years, I'd say, well, what are your standards? And lo and behold, usually your personal standards follow to your business. So in other words, are you achieving what you want in life? Why are you in your business? Why are you doing what you're doing? And then yeah, sure, 40% labor. That might be amazing because that's something that needs to happen for you to hit all of your other goals and metrics. And I just keep coming back to that. I'd say, well, what actually needs to shift in your business for you to do what you want? And if you're there, great. Enjoy that you're there. And then maybe you become the standard for other people. So that's kind of fun too. That's where I would go with it. It's just how I tend to operate. I did though, when I started a business and didn't know anything, I did that. I looked at, was like, how are clinic and gyms running? What's the expectation of this? I all the stats around like, oh, you don't buy for more than blah blah blah, and you have to do this and that. And I use them as like, even like initial pricing when I didn't know what to do or was thinking about that kind of stuff. I looked around plenty. You're going to compare yourself to your competitors, but there was one example, and I'll pass to Alex after this one, that I think of a lot where I'll never forget when pricing's a great example. One time someone said to me, hey, I changed my pricing to X because so and so down the road has that pricing. And I said, okay, cool. I went and talked to the person that's down the road and they go, oh yeah, I got a giant inheritance. I'm just doing this business for fun. I don't really care. They were losing like 10 or 20K a month. So you see where I'm going with it.
Not the group to model.
Not the one, but you wouldn't know that unless you deeply checked in on the whys or what the person was doing. And I've seen so many people replicate or emulate pieces of other things without knowing the full intention or reason of why it was happening. So just be mindful of that as you're looking in benchmarks. Alex, let's go.
Yeah. Benchmarks have created more stress in my life than stress that they've relieved. And so I just look at that personally for our business. No, like seriously. Like when I hear numbers of where we should be in terms of ROAS, return on ad spend, that for us, has that not been one of the more stressful things in the last 2 years? Once we got a benchmark and it was like, oh my gosh, we need to be getting 7x ROAS, 5x at the least, or we're cooked. And we were getting like 3x. And for us, that has been a like, oh, it's not working. When behind the scenes, it was like, well, also, we didn't have recurring revenue as part of our business yet. And so it makes sense. So I'm here to say, as a participant, as a fellow business owner who has also been concerned about benchmarks and metrics for ourselves, it has created more stress than it has alleviated for me. Is it useful as a direction? Sure. Is it what I should fall asleep at night thinking about? I'm not at this percentage. Absolutely not. And I think what happens is when we take that as gospel, as like, this is how my business must be, or I am not successful, or I will not be successful, that hurts us. For example, had a contractor once that ran an HVAC business. We were looking at his profit and loss statement, had incredibly profitable ads, like wildly profitable. And he was trying to grow. And he was getting like 10x ROAS on this thing, right? It was just like money printing machine. I was like, dude, why haven't you spent more on ads? It's working so well. Well, it's already 10% of my budget. Where did you get that number from? You shouldn't spend more than 10% of your budget on marketing. Like that's the benchmark. Screw the benchmark, man. You have a lever in your business that you could pull. And he got all flustered, like, oh, I haven't even thought about this. It's like, yes. So benchmarks can be useful directionally, but limiting specifically. And it creates judgment about how I am as a business owner. When, for example, our business wins because, like in the past, it has certainly won because we were better at marketing and sales than a typical like financial services firm. And so our USP for the people that we were hiring was like, hey, you might not make buku bucks like you would at this place down the road, but you're also not going to have to go do any outbound prospecting. You're not going to have to do any sales, and you're going to have ridiculous life balance if you want it as a result. And so if we were to benchmark our business based on other businesses, they would say, you're spending way too much on marketing and you're not paying your people enough. It's like, well, I'm running a different business, fool. So I will benchmark based on what I want. And when we benchmark based on what we want internally for ourselves, like what Ian has been saying, that's what brings down pressure. And it's like, cool. Don't let benchmarks be pressure for you. If they are, realize that there's all sorts of flawed things in tying your business to them. Take a breath and go listen to the next episode of this podcast. And that's all I'll say.
Yeah, I love it. I for me, I think it's one of those things where I just think if we're gonna put so much importance in them, if you're an owner out there and you're gonna put so much importance into it, where does it come from? Why? Who established this in the first place? You know, like anything, it's like, why does it matter? Is there incentive by the people who create these things that matter, right? Like, what are they after? Are we falling into their incentives? I do think one thing that you guys raised great points, and I think Ian, you know, at the end of the day, it's like, what does it matter in terms of your life? What's going to do? I think some things that I hope you take away from this, if you're listening to this and you've been operating off of, you know, I'm looking at other businesses. I need to hit certain benchmarks. One, owner compensation is not considered in these. And so one of the biggest things that we see, at least in our business owners doing $1 million to $10 million a year, owner pays a massive part of that. What is this doing for my life? You know, the kind of life I want. Then two, it's like, well, you might say, well, you know, I want to sell a business one day and I want to go to a broker and I'm going to do it through a brokerage. And, you know, it seems like these benchmarks matter. Well, they only matter to the degree that you can defend whatever you can explain. And if you can go back and argue and go, well, I know how you come up with all these. Like, do you know how they come up with all these numbers? I bet it'd be really fascinating. But we're in CFO seat and a lot of people don't know how these are even formulated, right? And people are making decisions off that. I'd be super curious to meet with, you know, some business brokers and be like, hey, break down the entire benchmark industry for me of how it exists, where they get this data from, what they're doing. No shade on any of those. Nobody wants to sit down and read where they get all this information from, right?
How we've always done it, Will. It's
always how we've done it, right? And so I think you knowing that, and someone goes, well, based on your benchmarks, we can't do this. It's like, hey, let's stop for a sec. I know where these benchmark numbers come from. Here's how they're skewed and why that shouldn't necessarily be an indicator of maybe what I should get in terms of a multiple. I think that's really powerful to have that information. And then to your point, lastly, of just, you know, Alex, I so wholeheartedly agree of more often than not, it's just an added stress of comparison, not doing enough. I need to hit this. And I think what's probably more helpful, and I guess has been more helpful in our lives, has been getting in groups of people with similar businesses and seeing what's working for them and what sort of metrics they're going off of. Not that that's the end all be all, right? It's a smaller sample size. Arguably it's self-selected, right? Or, you know, you're choosing what you're getting into in a successful group. But I think there's a lot more merit, just like to your point, Alex, of one CFO who sat in a specific seat working with specific industries of a certain size in a certain region is going to have far better ideas of what true benchmarking might look like versus where we're going and reading. Because I'm going to ask you guys, if someone goes to look up a benchmark, where do you think they go?
AI.
Yeah, AI, Google, right? They're just willy-nilly searching. They don't even know where it's going from. So I hope this was helpful. Did you guys enjoy this episode?
I had fun.
Cool. I know we got Alex heated, a little fired up, which I love to see getting in on that. So any parting words, Ian?
I'm going to go back to it. Beware if you're seeking out industry standards, because go inward and figure out what your own standards are.
Alex, how about you?
Yeah. Care about what matters and ignore the rest.
Woo. All right. We will see you guys on the next episode of Just Figuring It Out. Hope you guys enjoy this one. If you're interested, knowing that your business needs to get better, you need to get better, you need to level up your own financial education, go on over to ceofinanceacademy.com. Check out what we do, and we'll catch you guys on the next episode.